high interest rates and regional bank turmoil has raised concerns among investors about the state of the commercial real estate market. It is something Yahoo Finance Brian Sozzi asked David Hunt, the CEO of PGIM, about at the Milken Institute Global Conference Rick was just talking about. Take a listen to the conversation earlier this week.
So I think that we will see some pressure on the commercial real estate market for sure from higher rates. And I also think actually from the banking turmoil, as I mentioned, there'll be less credit provided from that group of players, and they're important lenders into that market. So that will create pressure. On the other hand, the pressure that creates opportunities for non-bank lenders. So, we actually would see, if you take the longer term, again, view of this, is that as we go through a credit cycle here, that the non-bank players will be well positioned for it. And as we look at our own track record as we've gone through downturns, our credit losses have actually been very manageable, and sometimes it's not a bad thing to flush out the system a little bit.
The consensus seems to be that the Fed is about to pause its hiking campaign, maybe a good thing. Do you think the broader equity markets will be off to the races now that they might be done doing this?
I think our view remains that at the moment the markets are over-optimistic around where we're headed with both rates and recession. And what I mean by that is that actually they're underestimating the strength of the American economy, which actually is in very good shape. The consumer is continuing to spend. Early days they spent money on goods, now they're spending money on services, but the economy is actually doing pretty well. That's the good news. The bad news is that means the Fed's going to have to do more to begin to slow aggregate demand. So our view is that rates are going to have to stay higher for longer than is currently priced into the market, and that's true both for the fixed income markets as well as the equity markets. So the latter half of this year, I think, is going to see some volatility, and we should be prepared for that.
Our thanks to David Hunt and, of course, Brian Sozzi there.